Charlie, I'm going to let you take over.
All right, Michael.
Give us your prognostications.
Okay.
And then we'll go to the Q&A.
All right, Captain, we'll do. All right. We're going to pretty much run the same drill that we run every year with regard to telling you what happened, why it happened to a certain degree, and then give you our estimates for what we might expect in 2020 with regard to GDP, earnings, and where the market might go. So let's get going. Let's see here. That's me. Got that figured out. And you should probably read this before I get started, just so you have some perspective on the value of chief investment officers and strategists. I'll give you a second to get through that. Last year, we said, I like Dilbert. Last year, we said we expected slower U.S. GDP growth in 2019, expecting a growth rate of 2.5%. We thought the overseas markets' economies would slow down enough that would drag down the U.S. We thought small business would do well. We expected corporate earnings growth of just 3%. We expected a 17 PE multiple on S&P earnings and a target of 28-22 for year-end 2019 on the S&P 500, which was 12% above the 2018 close. We thought we would see higher interest rates. We knew there would be trade friction because Donald Trump was signaling it to the entire world, pretty much. We thought nasty Brexit might be in the cards. And actually, this brings up a wonderful point of interest. Brexit passed the British Parliament today. Did anyone hear about it? It passed today. And to me, this is just a fantastic example of a quote from, I think it was Herbert Hoover, who said that you might see 20 or 30 impossible situations or problems approaching you on the road, but before they get to you, 28 out of 30 are going to be in the ditch. And this is a wonderful example of that. It took a while, but Brexit is going to happen, and it's not going to be the world-ending event that so many people predicted that it might be. So that's what we saw for 2019. Here are some of the numbers that tell us what actually did happen. We did see a step down in GDP growth. We saw GDP growth fall from the 2.9% annual rate, which is the red bar, horizontal bar on the left, down to what is estimated to be about a 2.1% year-over-year growth for GDP in 2019. So straightforward decline in real GDP growth, partly due to the trade issues, partly due to reduced capital spending on the part of corporate America as a result of some of the trade tension. But growth did slow in 2019. Also, and if you're going to take one slide that I have up here home with you tonight, this is probably the one that has the most implications for the future. This is a graph of the percentage of total U.S. GDP, and also measured as total U.S. income, that goes to labor. And this graph starts in 1950, runs through 2020, and you can see that for the 50-year period between 1950 and 2001, the percentage of total income in the U.S. economy that went to labor averaged about 63%. It wobbled around a little bit in that period, but something happened in 2001 that changed the whole game. As you can see, the percentage of total income going to labor collapsed in this period, and it fell for about 15 years. In 2001, China joined the World Trade Organization, and the implications of the Chinese capacity entering the world economy were profound. But for our purposes, we're going to focus on the fact that this number has been trending up for the last 3 years. Beginning in late 2016, early 2017, labor has been getting a better deal. This contributed to a reduction in profit margins for the S&P 500. Whoops, let me go back to that. In 2019. These are quarterly profit margins for the S&P 500. Here's Q4 18 right here. You can see we peaked out in the 4 quarters encompassed in 2018, and the number began to decline in 2019. Direct result of the fact that labor was seeing more success in the negotiating process with corporate managements. Profit margins began to decline in 2019 as a result of labor getting a better deal. We also saw share buybacks peak in 2018 as well. These are quarterly total share buybacks within the S&P 500. You can see these numbers peak in late 2018, and they've begun to fall off here in 2019. This includes data through the third quarter. We don't have fourth quarter numbers yet. But the point being that not only have profit margins declined as a result of labor getting a better deal, but corporate America is spending less on share buybacks. So you combine those two with the fact that during the year we also saw a very significant decline in interest rates. And this is a graph of the 10-year yield on the U.S. Treasury. Between 12/31/18 and 12/31/19, the interest rate on the 10-year Treasury fell by about 30%. So we have a lessening in profits and a significant decline in interest rates during the year, one of which we predicted, the second we did not. So here's how the year turned out in terms of the raw numbers. Our estimate for GDP growth for the year was 2.5%. The actual result, about 2.1. Again, the final numbers aren't in yet. S&P 500 earnings, we were looking for a number of $166 per S&P 500 share in the aggregate. The actual number is going to come in around 163. So the decline in profit margins, the reduction in share buybacks, impaired corporate earnings a little more than we thought they would, although we thought they would be impaired somewhat. Yet our target for the S&P 500 in terms of price was 13% too low. Here's the number we gave you at the end of last year for a projected target for the S&P at the end of 2019. This is where it came in. Why did we miss so much? Why did we miss by 13% to the downside? Your answer is right here. Price earnings multiples, the amount that shareholders are willing to pay for $1 of earnings, it's expanded by 3 clicks during the year, rising from 17 to 20. And the reason that happened is because of the big decline in interest rates. PE ratios vary inversely with interest rates. When interest rates fall, PE ratios rise. We didn't expect as big a decline. We didn't expect any decline in interest rates in 2019. We saw a significant decline. That pushed PE ratios way up. It pushed share prices way up. So we can probably say, thanks, Fed. The Fed giveth. If you're going to write the epitaph of investing for 2019, it really comes down to the Fed did it. If you remember, in the first couple of months of 2019, the Fed reversed course, decided that they were going to begin to reduce interest rates instead of continuing the normalization process or the process of increasing rates that had been in place for the previous 2.5 years. And so that allowed markets to advance and allowed PE ratios to rise materially. So our target was 28.22. We ended the year at 32.31. We were low by 13%. Again, we misjudged the Fed. They cut rates instead of continuing to raise them, and that pushed PE ratios up. Thanks, Mr. Powell. Okay. What about 2020? We've subtitled this one, "And the Fed Taketh Away." We do expect a little bit better GDP growth this year. The U.S. economy should grow somewhere in the mid-2, 2.5, 2.6% range for the year, our best guess, about the midpoint of the previous 2 years. In this year, the recovery in the overseas economies should be a tailwind for the U.S. economy and markets, as opposed to a headwind in the previous year and a half. We do expect the rate of hiring to cool somewhat in 2019. Wage growth should hold well above 3%. It's been rising. It's given back a tick or two in the past few months, but we do expect wage growth to continue in north of 3% this year. We expect immigration to be a significant contributor to the lack of immigration to be a contributor to wage growth. Expect corporate earnings to rise 6%. We do think margins will continue to notch down as labor continues to get a better deal. And share buybacks will continue to fade. We think there's going to be a certain amount of political pressure against corporate buybacks, particularly if the Democratic candidates for president do get their voices heard on corporate behavior. Our estimate for S&P 500 earnings is $172. We're going to put an 18 multiple on this earnings number because we do expect in the second half of this year, because the economy is healthy, we do expect the Fed to get back to trying to raise interest rates. So we have a target for the S&P for year-end 2019 of 3,100. Now, those of you that pay close attention to these things will know that the S&P today closed at 3,326. This target is 7% lower than today. So what I'm saying here is that basically the 11% move we've seen in the S&P 500 index since Halloween has discounted all the good news that we're going to see in the marketplace in 2020. That's the bottom line to my remarks here tonight. Discounting none of the potential bad news, including a Fed determined to get back to raising interest rates to try to normalize them after a decade of suppressing them so aggressively. So that's our sort of quick sketch of what we see for 2020. I wanted to end things with some sort of a little bit of perspective on the longer term. We're celebrating 25 years here tonight. I wanted to try to give you a little bit of perspective on the last couple of decades. This graph really, to me, says a lot about what's been driving the U.S. financial markets for a couple of decades now. This is a graph of U.S. private sector financial assets as a percentage of GDP, the value of all stocks, bonds, everything you can think of that's considered a financial asset divided by GDP. And you can see that for the 40-year period after 1950, this number never really pushed through the 3.5 times GDP number. Beginning, coincidentally, in 1995, we broke through that number, and it's been onward and upward ever since to the point now where we're today. The value of financial assets in the U.S. economy is 5.6 times the GDP of the U.S. We've increased the amount of debt in the system. We've increased the amount of leverage in the system. The Fed has basically come to the rescue of financial markets time and time again. I'm not going to really make any editorial comment about this graph, but it's something we all need to be paying attention to, and I'm paying particularly close attention to it. Because if this trend changes, it's something that could roil the markets and something that we need to pay attention to. It's been a happy tailwind for 25 years. We've been fortunate to be in the business that we've been in, and you folks have been fortunate to be invested in this period. So, let's put a little perspective on the returns that we've generated for our clients over the last couple of decades. And I need to preface this by saying, even if the happy environment that I just mentioned with regard to the growth in financial assets doesn't continue, it doesn't mean that our clients can't be successful. And the table that I show here really brings that home. This is a table that shows you annualized total returns for the S&P for 2 different decades and then the entire period, 1999 through 2019. As you can see, the period 1999 to 2009, we had 2 recessions, and as we discussed before, 2 stock market crashes. In that period, the S&P generated a total return of minus 0.99%, almost negative 1% per year total return for the S&P 500 index for that decade. Our client portfolio's annualized total return in that period was a plus 3.2%, for a net difference of just over 3.8% in terms of positive to the client's benefit. In the next decade, The S&P, and it's been a wonderful decade for total returns, the S&P returned 13.5% per year. Our client accounts returned 11.39% per year for a delta of minus 2.12%. This is a reflection of, in a bad to mediocre market, the value style which we espouse always does better. So in the period 99 through 09, we had a bad to mediocre market, and the value approach, good companies, reasonable prices, don't chase growth, did quite well relatively. We generated a total return of 3.8% annualized. And then, once we got through the crash in 08, 09, and the Fed started to aggressively suppress interest rates, growth became all the rage. 4 or 5 years ago, we started to hear about the FANG stocks, you know, the Facebooks and the Apples and the Amazons and Googles that have become such a big part of everyone's portfolios and have been leading the charge in terms of total returns in the market the last 10 years. We don't tend to do as well in that environment. We tend to make less when the markets are roaring ahead, but keep more when things are bad. And the keep more environment, the environment where we're telling our clients, stick with it. The S&P's down 40%, your account's only down 18 or 20. Stick with it. We understand the world doesn't work in a straight line. Things will get better. In the meantime, you're not losing as much. That really is key in helping keep our clients invested, which is, over the very long term, really what matters. Okay? So that's a little perspective on a couple of the 2 most recent decades. And finally, to sort of emphasize the idea of total return for value versus growth. This is a graph of the historic returns of a value-style investment approach versus a growth-style investment approach. And where the blue line is rising, value is outperforming. Where the blue line is falling, value is underperforming. You can see over the modern history of the modern U.S. stock market, beginning in the late 1930s, value has a considerable advantage, an annualized total return to the tune of 4% per year. But there are extended periods where growth significantly outperforms. We can see one of them in the period 1995 through 2000, when we first started Fort Pitt Capital. For the clients who have been with us for 25 years, the period 1995 through 99 was a rough period for us. Our portfolios were growing at 16, 17% per year, but the S&P 500 was compounding at 22, 23% per year. When you're behind the market by 6% a year and you compound that deficit for 5 years, clients get unhappy. But, as we talked about before, value took over in the period 2000, 2001, 2002, and that's where our portfolio shines. So this decade, 98 through 2009, value line is rising. We ended up here in 2009. Basically, since 2009, growth has won the day. We're saying at some point, once more, we're going to come out of the wilderness, and value will win the day. Bob Prince, the old pirate announcer, used to call it the hidden vigorish. It's basically regression to the mean. The idea is that over time, we will regress to this mean. We just don't know when.